Good afternoon, everybody, on the East Coast, as well as our friends in New Zealand, and for everybody else, including Hong Kong. Good morning to everybody. Thank you for joining us for our second of our September webinars for Meet the Managers. And today I'm very happy to have both Renee Hung and Doris Ho directly from Hong Kong. As many of you know and have seen for many years, Renee is the Senior Investment Director as well as the Portfolio Manager for both Premium China and Premium Asia funds, and Doris is her 2IC for both our strategies. So both of them will be speaking through some of our key questions today. Just some quick housekeeping things. So firstly, today's webinar is CPD accredited by the FPA. The way that we will sort of implement that is at the end of this webinar. So when I click end, the system will actually jump a internet browser launch, and your internet browser will basically come up and will give you 3 quick questions to answer. They're just feedback questions. Once you complete that, then our system will trigger a notification saying you completed that survey, and then we will send you out your CPD points. So without filling in that 3-question survey, it's our sort of trigger as whether or not you were with us till the end, because obviously the rules regarding CPD points are now much more strict than they used to be. Also, today's webinar is also recorded, and as part of our monthly updates emails, we will be connecting or linking that recording for you to share with your colleagues. Also, one thing I forgot to mention from yesterday's webinar is that, as you all know, there is the new compliance regime for DDO. And there's been a number of advisors that have been asking us about our target market determinations. So rest assured, on the 5th of October, those are being launched. All the platforms have received our TMDs to date. So if there's any questions when those TMDs actually go live on the 5th of October, please reach out to myself or Derek, and we can certainly walk you through those. We know that there is some confusion and there's also some controversy with regards to those TMDs. We have ensured that there is no distribution conditions with regards to any of our 3 products. So hence removing a lot of the barriers for you to obviously utilize our products within your client portfolios. So just to give you guys a few introductory slides this morning, our standard disclaimer. And just to give everyone an update, Value Partner is still managing about $11.5 billion US, and that's effectively split $4 billion in fixed income with the remaining and the majority in equities. We are a value manager, but we are not a deep value manager is probably the best way to put it. We are contrarian in a lot of our views, and you'll see that when I start asking some of the questions to Renee, especially with regards to our tech holdings. And we have the largest investment team on the ground servicing any fund with exposures in Asia today, with around 70 investment professionals. And if you sort of view the split of those investment professionals, 37 of those team members is in equities, and then the rest is supporting that from fixed income, which we went through yesterday. And thank you for those that attended yesterday, as well as private equity, multi-asset, quant, and big data. And obviously a very strong risk management and compliance and dealing presence as well as part of that investment team. So, for us, we are not top-down managers. We don't make macro calls. We are bottom-up in the way that we stock pick. And the thing that we pride ourselves on is the fact that Value Partners does at least 6,500 company visits per annum. That is a record that no other manager, I think, even globally can match in terms of our on-the-ground footprint. And because of the fact we have on-the-ground presence in mainland China, in Hong Kong, in Malaysia, Singapore, we are very well covered across the Asian region to bring those best of ideas all the way from North Asia, Korea, all the way through to India. So, and we're going to go through our India thesis as well with you guys today. ESG is probably quite an important topic to also discuss through briefly, and what I probably plan to do in the next couple of months is bring Frank Choi, which most of you may have seen in Australia in the recent couple of years that we've had roadshows. Frank is actually the head of ESG now for Value Partners, and he heads the committee. And one of the interesting things, and probably one of the highlights about the way we have approached ESG is it's really about continuous learning. And it's not really about, okay, we've implemented a policy and then we just hopefully fit all our investment ideas around that policy to sort of make things fit. Because the problem is that the concept of greenwashing is a very big problem. So originally, Value Partners, after being a signatory to the UNPRI in July of 2019, they put on a company called Rep Risk to effectively give them negative screening capabilities over companies, but quickly found out that there is a problem with that approach. And the flaw in that approach is specifically due to the fact that a lot of the data is outdated. It actually created more impediments for the team to actually execute on ideas. And it wasn't providing the analysis that they needed. So what VP has actually done now is they've built their own proprietary screening tool, screening questionnaire, built off the back of their 25-year plus research capabilities, and decided on, one of the most important things that is important in analyzing companies across Asia, including whether or not the company's been embroiled in any bribery allegations, for example. And through a lot of the one-on-one meetings we've had with Renee and Doris over the last couple of days with our key clients, we're happy to share an example of a good ESG company, as well as an example of bad, and bad being one of those, that particular pharmaceutical company was embroiled in bribery scandals, something that a lot of the data companies simply can't provide that level of analysis for us. So we are very much dedicated to ESG. And it's an ongoing process, and the team hopes that by the end of this year, all our holdings will have a full ESG questionnaire attached to it. But what I might do is sort of loop back around to that in the future and do a dedicated webinar on ESG with Frank. Just to update everyone on performance, as you can see on the screen here, this is the performance of our Premium Asia Fund. Very, very highly competitive, both from a fee perspective. So we dropped our fees in July of 2019. To 1.33%, which is in effect, we are 2 basis points cheaper than the competitor you see there on screen. But if you look at our after fee track record since inception, which is over 11 years in length, we significantly outperform our biggest competitor, both on a cumulative basis as well as on a calendar year basis. So what we are bringing, what we have in the market now, and it's available on all major platforms, is an Asia exposure with a team based in Asia that has all the on-the-ground insights. And we don't sort of add a lot of bells and whistles to the strategy. We're not long short. We're effectively a long fund. We don't actively play currency because the currency is unhedged, and we also don't short stocks. So a lot less explaining that you need to make with your clients. And sort of on the back of that, our longer term track record, when you sort of look at the amount of risk we're taking in the market as well, it's very, very attractive. So on every time period on a Sharpe ratio basis, we beat our peer median, as well as on the information ratio as well. And what's probably most stark in the chart you see on the screen at the moment is on the furthest right-hand side, on the 5 and 7 and 10-year basis, the peers actually struggle to outperform the benchmark, and at the same time, they still actually are taking on more risk than desired. So again, it's a reflection of our very bottom-up, high conviction basis. So with that, I just want to start on sort of a few questions for Renee and Doris, which is sort of a culmination of a lot of things that we're being asked at the moment. And probably off the back of what happened in July with the after-school tutoring sector, we have seen quite a large divergence in views, is probably the way to put it, with regards to the approach to Chinese equities overall. We have seen most global managers that either have no presence in China or have very little presence in China have come out with a rather uniform line of saying that China is full of regulatory risks that we didn't fully comprehend. We have now structurally decreased our exposure to China. But all the managers that actually have on-the-ground experience and understand the culture and actually understand the environment that we're operating in have a very, very different viewpoint. And so, the first question that I have for Renee is that, Australian advisors hear about mega cap Chinese stocks by global managers. And a lot of those global managers buy Alibaba, they buy Tencent, and so on and so forth. But even through the latter part of last year, especially with regards to Alibaba, we started to see some risks in that sector overall, but we at the same time went further down the market cap spectrum and found some value for investors. And so given the recent regulatory crackdown on the internet sector in China, have any bargains emerged?
Yes, thank you, Jonathan, and good afternoon, ladies and gentlemen. Unfortunately, I cannot be with you together in the same room, but I hope we can do so very soon. So anyways, for this question, yes, I would love to share our view. So I think for us at Value Partners, we always tell investors that we try to understand the business. So when we try to understand the business, we try to do due diligence on the whole supply chain, competitive landscape analysis and all that. So all along, when we invest for our investors in some of the mega stocks, we also talk to a lot of the second tier, third tier players, or even like industry players to get different views. So I think for now, more people are focusing on the non-mega caps given the latest changes in policies. So for us, of course, we have all along do the same work. And what we see is that I would also like to explain a little bit the rationale behind what's happening in the internet space. In the past, I think in China, a lot of quick and rapid developments in the industry and a lot of big players emerge in the internet space, no matter it's e-commerce or gaming or food delivery, etc., etc. So over the years, these companies have become so powerful that they have a lot of bargaining power over their vendors. Take Alibaba as an example. They have been the major player. I'm talking about 80%, 90% of market share in e-commerce easily 5 years ago. And then despite their market share has been coming down, they are still the largest player with more than 70% market share in e-commerce. So much so to the stage is that they can require, or actually they can make their vendors, say if I am a brand owner and I want to put some of my products into Alibaba's platform to be sold and reach out to the population in China, I have to comply to Alibaba's request, which is like if you sign with us in Taobao or Alibaba, you cannot sign with the second player or the third player, for example, Pinduoduo or like even VIPS. So as a result, you can see like this slide, some key brands, easily 90% of the product or even more are sold via Tmall, which is under Alibaba. And the other two players have no way to sign these brands. So, I mean, everybody is chasing those brands after all in China. So all these key brands are limited by the request for restrictive policies that Alibaba has because they have so much bargaining power. So I think in China, government's view, there are many things that they need to tackle. After all, it is a fairly new economy in comparing to a lot of Western world. So there are many challenges that they face. For example, if there is no competition, meaning that, or maybe very little competition, not only the largest player will become the largest one and no one can compete, the small medium players can never have ways or have any chance to also emerge. So this actually would become very bad in the antitrust space and also provide in future when the industry further develops, no competition in the market, meaning that there's no check and balances, there's like no market driven activities can be possible because they will be the largest player. So I think that's why we have seen that we have these kind of regulations and policies in place. First of all, not allowing Alibaba to enforce this kind of policy anymore. And at the same time, we do see the small, medium enterprises are actually going to increase in competitiveness. For example, Pinduoduo, they are also actually doing very well in under the such a strong player against Alibaba. So now we also have more work and do more work on this company, and we learned that the company culture for Pinduoduo is very different from Alibaba. So Alibaba is used to be one of the largest company, and maybe the history is very long, and they've built a lot of clusters of management, meaning that over the years they have become a little bit more bureaucratic and more political within, and they need to try, of course, very hard to in a very competitive within the company. Pinduoduo, on the other hand, from our on the ground understanding, it is more active, it's more like dynamic, and the team is more smaller there, meaning that they can be very efficient and very active in trying to adapt to the market changes. So basically, when we do our research, we note that actually the changes over the years in Alibaba's culture. And I think for last year, as Jonathan pointed out, we had a very quick reduction in exposure in Alibaba compared to a lot of global managers. It's because from not only like from on the ground, we are aware of the changes in the management situation. Another catalyst is that we saw that the failure to go listing on the Ant Financial is actually is a catalyst also for us. First of all, we are also aware that more policies will be coming to address, especially on the internet banking. And we understand the rationale behind on the government too, because internet banking has been growing very rapidly over the years, and it's so fast that, and it's such a new business model that there are not many precedents or maybe regulatory framework in place to control. But after all, when it reaches very big size as what they did after very successful years, we see that actually we do need some check and balances to control. Otherwise, if anything blow up in the Ant Financials or maybe internet space, basically a lot of population in China would be impacted. So all in all, it triggers us to revisit, and then not revisit, we constantly think about it, but actually challenge the thesis of whether that we should hold Alibaba as such a big holding for the portfolios. So that's why we have also increased our exposure in other second tier and third tier names. So now we definitely has been continuing doing our research. We expect that on the policy front, on the internet space, will continue to come out in the next few months. But the worst time for policy out has been over. I think in the past few months or weeks, a lot of people has been more like more confusion or a little bit sometimes even shock. So for us, yeah, we have some position, and we also saw some value, and then we are also hopeful. You know, I think for some of the investors with us, our financial consultant has been with us for many years. Maybe you also remember in 2013-14. When President Xi first came into office, he launched also a lot of campaign, for example, anti-corruption campaign that hurt some of the large consumption names in China then. But then after all the policies settles, companies try to change the strategies and adapt to the new environment. Actually, we made so much money on those stocks. I remember we made like 2 times, 3 times on those stocks. So I think for us nowadays, we definitely see opportunities and value in this internet space still. Yeah. I
Fantastic.
hope this
With over to Doris. I mean, China has been doing a pretty good job of COVID containment overall, but obviously, just very similar to Australia, it's been at the expense of closed borders. And so, how has that affected your investment decisions, and have you seen sort of opportunities off the back of that?
Right. Thank you, Jonathan. Good morning, everyone. This is Doris. So with our on-the-ground research, we see that the world has changed after, or we start to live with COVID for more than 1 year now. And then I think then including China and all of us would accept that COVID will stay with us in the foreseeable future at least. So we try to combine our observation with our regular update with various sector and company, and we know we would like to share with you 2 opportunities in China that we have been investing in. The first one is export related, which is the shipping company. For shipping companies, shipping is always a cyclical sector, and we have covered this sector for more than 10 years. The last boom cycle was already more than 10 years ago, and at that cycle we also successfully captured the opportunity to buy at the bottom and then make the very huge profit. And this time, and after that, as you can see on the freight index, the shipping sector has been stayed very stagnant for the last 10 years, but we have been updating with the company and sector still regularly. And we noticed that since second half last year, China has successfully contained COVID, and then being the first in, first out country comparing with other peers, US, Europe, etc. So, and at the same time, even though US and Europe were still under lockdown for most of the time last year, their consumer demand has not been jeopardized a lot, given by the various stimulus policy and work from home derived demand. So it became more apparent to us gradually that the export growth from China to Europe and US actually have not been very depressed. And then given China's industrial operation has been still pretty much working normal comparing to other Asian countries. So the demand supply situation for export has become very favorable to Chinese companies. And then one of the outcome is that the China US or China Europe freight rate has become to rise continuously since second half last year, from usually under 1,000 US dollar from China for the route of China US, and then gradually up until now already rise by 10-folds already. So we started to, because we have been following this sector very continuously comparing to many other investors, because many investors have given up for this sector for many years at that point of time. So we managed to build up our position quickly early last year at around at that time 6 or 7 Hong Kong dollar, and then given the earnings upside that we all the investors started to appreciate. So you can see from the share price chart, the share price has more than doubled, and we have made very huge profit from this position. But given that this is to us is more like a 1-year trade, so we have gradually trimmed down our position and at the stage of taking profit already. Another stock idea we'd like to share with you is about duty-free in China. The leader in China is called China Tourism Group Duty-Free Corporation. This is the dominant market player with over 80% market share. For duty-free, we need to understand that from the luxury or high-end consumer brands, this is a specialty channel which they would manage very hands-on. Because that related to the brand building, but at the same time they would like to limit the merchandise supply. So to work with a big and efficient duty-free operator globally to the brands are very important. They are very selective. And then so even though investors in China usually would see that it's just another licensed retail business, and then China has given out a few SOEs for this duty-free license. They missed the point that actually China Tourism Group has stand out to be the most efficient operator with their very strong merchandise arm and brand relationship, given their scale and their very sophisticated merchandise and logistics system already building back end. And then that combined with the policy support of Beijing since last year on Hainan Island, because our government has been committed to make Hainan to be the onshore duty-free destination for mainland tourists, and then that has become top priority, priority policy to Beijing government since start of COVID, because leisure travel has become much more difficult, and it seems that it's very difficult for leisure travel to resume normal now after more than 2 years of COVID coming to stay with us. And then so for China Tourism Group is very well positioned to capture the opportunity in Hainan with their strong market share and then strong merchandise relationship with the consumer brands. And that's why the share price, you can see that since early last year, it has more than doubled within 6 months, given the policy loosening from China. And then we started to build position after a pullback in mid last year, given that people may think that COVID would be something to stay with us for 1 year and then they will go. But we see that gradually the data on the ground and the consumption data that we see is that domestic consumption and the market share gain of China tourism would be more like a structural growth for coming 3 to 5 years. So that's why we continue to build our position. And it turns out that for this year, the earnings of China tourism would still surprise the market on the upside. And then it has actually announced to go IPO in Hong Kong also, given that their ambition to become a global leading player in the duty-free sector. So we see that for the coming 3 to 5 years, China tourism would become a very important duty-free operator, even on the global level.
Fantastic. Staying on sort of the consumption theme, Doris, you know, outside of China tourism, have you seen any other themes emerge domestically?
Consumption growth has always been a key growth driver for China and the sector that investors like for the past decade. And then recently we have talked about consumption upgrade, meaning that in the maybe 10 years, since 10 years ago, people, there are rising of middle class, and they have developed a preference towards upgrading their consumption towards foreign brands. For cars, they would like European brand. For sportswear, they would go for Nike. The aspiration would be go for Nike, Adidas, and maybe for dairy product, the infant milk powder, they will go for Nestle. That has been a trend for many years, and up until maybe three or 5 years ago, we started to see that actually, because of the rise, the millennial has gradually become a major driving force behind the consumption upgrade. And because of the different upbringing, they no longer automatically would see global brands or foreign brands is more superior to domestic brands. Because previously domestic brands in China are seen to be a value brands with reasonable pricing, but at the same time, quality or brand identity would be more mass or lower end and on the brand's spectrum. But for this millennial, they no longer see that domestic brands would automatically equivalent to value brands. They are and this is combining with the fact that many of these domestic consumption brands over the past decade, they have upgrading their R&D, their product quality, and more know-how on brand building, on how to make themselves more appealing to domestic consumers. So as a result, we can from our continuous update with the market research or some focus group that sometimes we will join, we noticed that domestic brands would become a choice of a top choice of consumption for millennial, especially in some in product include dairy, sportswear, some toys, much more younger generation appealing product. So that's why we try to identify the winner that we can invest in the capital market, and sportswear has been our favorite for the last 3 years, because sportswear would become more appealing. Naturally, it's more driven by the younger generation, and at the same time is supported by the policy. Especially after COVID, China government has become more sensitive or diligent in promoting overall social welfare. And that's why we have more changes in regulatory environment, and at the same time, they have been giving out support to selective industry like online duty free that I share with you just now on China Tourism Group, the support that the government is giving to them. Another one is sportswear. Government has announced that it would give support through promoting the Chinese citizens to more regularly participate in physical exercise through the education or providing the necessary infrastructure. So we see that as a result, a certain sector, including sportswear, for the coming 5 years can continue the strong growth from the last decade, comparing to some other consumption sector, including soft drink. Maybe they have been very well penetrated already, so it's very difficult for them to sustain the same momentum in the next 5 years. But for sportswear, we even before this year, we see that it would continue to be a structural growth driver or consumption upgrade, and they are in the capital market. They are good investment names that we can build a good position and enjoy the upside of this sector. One of them is Ning, because this is the most premium domestic brand, sportswear brand in China, and is been with a very strong track record in Hong Kong capital market. So we've been investing in the Ning for many years now, but sometimes we would adjust our position depending on the valuation. Since in the past 2 years, we first invested in Ning earlier in 2020, and then after the first wave of COVID gone away in China, the share price has recovered very quickly. So we at times in second half last year, we take some profit, but given all the data that we got on the ground from about Ning's end demand and the government policies direction, we understand that for the coming 5 years, Ning would continue to win market share from their global peers, Nike and Adidas. So we decided at that time, when the share price has become more stable, we build up our position again. And with hindsight, it turns out to be a very good position, because earlier this year there has been the incident of the Xinjiang cotton, driving the consumer demand very quickly from the global brands to domestic sportswear brand, and Ning automatically will become one of the winner. And then for a few months this year, they enjoy a surge in demand with retail sales growth over 30–50%. Now the situation has become more stabilized, but we see that the domestic brand market share gain from global brand would continue, and that would support Ning to continue to grow at over 20% continuously for the coming 2 to 3 years easily.
Fantastic. One of the other, I guess, major topics that a lot of people are talking about, especially even global fund managers, if anyone's tried to look at a lot of the electronics companies or trying to buy a car, you'll see some rather perplexing issues, including you might buy a new car now and you're only going to get one key until they can get enough chips to give you a second key at some point down the road. So this whole issue about Chipageddon, or otherwise known as a global semiconductor shortage, is something that's going to hang around for quite a while. Now, most global managers have talked about TSMC. We have a good position in TSMC as well for a very, very long time, depending on the valuation. And Renee, the question to you is, TSMC can't be the only opportunity, right? There's got to be something, there's got to be other companies also in the space, because at the end of the day, not every electronic good needs a TSMC high precision chip.
Yeah, no, I think also not only that TSMC, of course, will be doing very well. They continue to be a leader. That's why it's also in our portfolio. But we also see many opportunities in other names as well that are not as widely mentioned, as TSMC. I think for us, TSMC is a very wide-known story. So maybe we can also add some alpha to the portfolio by finding some lesser-known names, but they can generate much more interesting growth than TSMC going forward. So I totally agree. Semiconductor cycle is still undergoing a very big tightness, depending who you talk to. But some people also expect the auto semiconductor chain will encounter shortage until end of next year or even 2023. So I think it's not something that easy to to overcome in a 1 year time, because there are so many increase in requirement in different applications, including AI, data center, IoT, Internet of Things, But I think the key is that why there is such shortage. When we look through the whole value chain, it's very easy to understand, because for a lot of these technology companies, whenever they increase capacity, they need to order high precision equipment, sometimes even from Europe or Japan, which has been impacted by the lockdown previously. And also in the past, the production capacity is not is always they have some room to increase capacity, but suddenly with the work from home and then EV, all these demands suddenly jump up within a very short period of time. Actually, the time lag to order these equipments is actually much longer than before. And then also, when you first start to build a new capacity, it takes time for the production to ramp up. This takes another few months. So we believe that here and there, a lot of, depending on which part of the cycle, which part of the value chain, at least for the upstream foundry, tightness will remain until the end of next year for sure. This is very favorable to TSMC and its peers. So for other than TSMC, we also identify a company called UMC listed in Taiwan. We know this company for more than 10 years. We also do a lot of checking with the TSMC, UMC peers, including Vanguard, which is another company listed in Taiwan, or Samsung Electronics, or some other Singapore or Chinese foundry companies. So we have been verified actually in multiple aspects that the tightness is actually continues to be very real. We do hear here and there some occasional volatility in demand. For example, smartphone, I think after 10 year or plus very strong growth, we are seeing some lower growth rate in smartphone space, but we do see continuously electronic vehicle, data center, etc. These high powered chipset manufacturing are still in shortage, and hence benefiting even UMC, Vanguard, etc. And why we like UMC most is that UMC has some story behind. They had a management team change about a few years ago because the older management team, they have different challenges at that point of time, and they were not as profitable and not as smoothly, in terms of manufacturing process as other peers then. But they did a lot of things. And in the past 2-3 years, they have proven themselves that they are as good as Vanguard or TSMC in some of the selective segments. And we believe that this performance are beginning actually to be realized by investors. Hence, last year when we first bought into the stocks, the share price have been gradually re-rated. And we basically bought around, I think first bought starting about $30-something, and now today is trading close to $70. But still the valuation have a lot of room to go. So for us, it's a very interesting idea, and then we still keep this in the portfolio.
Fantastic. Now, outside of sort of China and Taiwan, and obviously we've got our positioning in South Korea, do you see any investment opportunities in India?
Yeah, in India, I think for us, we also cover our Indian market for many years because, for our supply chain analysis, we always encounter peers, not only from Korea or Japan, even from India or US or Europe. I think it's not sensible for us to only focus, if say we invest in names in China or even Taiwan or Korea, just those names, because the competitive landscape is globally. So we are familiar with those companies, but the thing is like we always complain on the valuations. We see India as a country very similar to China in a lot of aspects. So recently we have about a low single-digit exposure in India because with the COVID very challenging case last year, we did see some opportunities in some of the financial names. So we started to have some smaller position there. We did some switching among the names in India a little bit, but generally we see India as a potential opportunity. Is that first of all, the COVID situation now compared to maybe 3 months, 4 months ago is quite marked improvement. And secondly, India is compared to ASEAN country, they are also better off in terms of the COVID situation now going forward. And then they are all facing some low base number. So it's easy comparison. And a lot of investors globally, maybe because of the language, they all speak English. So it's easy for them to go back into the country. So that's why we have some small positions in India. We also see opportunities in IT companies and also maybe some private enterprises. And so that's why we are also having some small positions there. So this is the name ICICI Bank is the position that we have now in the portfolio. We used to invest in HDFC, one of the leading private sector bank as well. But afterwards, we believe that with more focus on the improvement in the loan book quality in ICICI, we believe that the valuation would catch up, and we were right too. So that's why we also made a successful trade year to date. But we are also having seeing some opportunities, maybe hopefully in the next few weeks or months when there's market volatility, to add more position in IT companies in India, because we do see IT demands for clouds, AI continue to grow. So not only Taiwanese or Korea or Chinese player are actually benefiting from it. Indian IT services companies are also very interesting. There are also some selective names like maybe like some medical related companies in India we find interesting, because maybe the traditional business have some kind of impact from the from COVID, because people go less to hospital unless it's emergency during the COVID. But they have been also, there are also companies that also develop successful like medical related platform for people to go online. So I think, you know, these kind of combination of traditional business and successful online strategy can be also interesting in India.
Fantastic. So we've got a couple of questions that have come through. So let me sort of run through a couple of those. There's a question here in regard to the new audit rules from the US SEC and the 3-year window. How will this affect money flow from the United States, and will it cause less capital inflow into China?
No, I think actually the liquidity globally is abundant. So I think even with here and there different policies, there are a lot of money that can find their way into this part of the world legally. And I would say that basically the market size is still much smaller than US market in this part of the world. So not only that, but also for China's outflow in money, because there are so much liquidity trapped in China over the years. We are also seeing that a lot of corporations or household within China trying to come out of the domestic onshore market to China or even Asia ex Japan, because they are more familiar with the market. So I don't think that is too much of a concern for us.
Okay. Probably outside of after-school tutoring and obviously the tech sector, the other big thing that everyone is talking about is Evergrande. So I'm just going to put up on screen the positioning we have in real estate is very, very small across both the Asia and the China funds. So can we just get your thoughts, Renee and Doris, on you know, the potential problems with Evergrande? And do you think there's going to be any broader impact on the market? Obviously, in our portfolio, we don't hold it, so that's fine.
No, I think for especially in China related, I think the government has been very clear that they don't want to promote any asset or property bubble since President Xi came into office, like almost 10 years ago. In the previous cycle, yes, they rely a lot on property to drive investment, to drive GDP growth. But this has not been in the case for the past 10 years. And then liquidity situation in China has always been controlled tight. So sterilization in the system was severe. Hence, we have the liquidity crunch when President Xi came into office almost 10 years ago. So over the years, we believe the corporations are used to it. But of course, here and there are 1 or 2 or 3 players sometimes are still still maintain a very aggressive stance or maybe aggressive strategies that led to like the Evergrande case. So in the Evergrande case, for us, of course, we believe that we are not impacted, because first, we don't invest in Evergrande in these equities portfolios. Secondly, we also have very low exposure to real estate. And then so the key is that whether this name going eventually maybe what the outcome would impact to the economic or maybe landscape or liquidity situation in China in general, that would impact on the general economy. So for now, we understand that, first of all, we don't believe that the Evergrande situation will create any systematic risk in China. NPL has been scrutinized in the past 10 years. Basically, all other players are very careful. All the banks are very stringent in terms of providing property mortgage loans or maybe writing off different NPL consistently in every year in the past 10 years. Evergrande is a case that they need to take time to how do you say, orderly manage. They will not say it's unlikely that they will have a very easy rescue for this name. But then we don't think that during the course of resolving the Evergrande would also create a lot of banks going in problem, or maybe government, or maybe private enterprise having any key problems. So so I think it will be contained to a certain, I won't say corner, but then still for a lot of people would not be impacted. So for us, I think we are comfortable with the Evergrande, but of course we would still monitor the situation. Yeah.
Sure. One admin question. So is the Premium China Fund on Panorama? Yes, we are continually getting this question. Please keep reaching out to your BDMs. It is a, how do I put this in a delicate way? It is a very unique situation to get a fund available on Panorama, because all the existing holdings that anyone has had in our funds under BT Wrap or Asgard have now been successfully migrated to Panorama, but you can't add any new money in. So all we can say is we've got a very, very long list of advisors that want to access and continue to write Premium Asia Fund on Panorama. So please keep reaching out to your BDM. We are also continuously engaging with fund governance as well. So we hope sooner rather than later it will be available again. We don't see any issues because anyone who's had the holdings has already been migrated to Panorama. With regards to research, Longset recommended, Zenith recommended, SQM 4-star. We are not rated by Morningstar on a qualitative basis, but we have a 4-star quant rating by Morningstar. In terms of, there's a few other questions about Evergrande. So to be clear, our bond funds have also not held Evergrande, but it's been very interesting to see if you run a Bloomberg check, for those of you that have Bloomberg screens, have a look at who holds Evergrande. Because it's the who's who again of global bond managers. Here's an interesting question. Obviously a lot of people have always talked about China having its corruption issues, and on a corporate governance basis it's not as transparent as potentially other countries. Do you see similarities in the Indian stock market, and do you think India is, in the same sort of position as China was maybe 10 years ago with regards to lack of transparency, bribery, corruption, those sort of issues?
Yeah, I suppose like in India, we do see that maybe they have their fair share of corruptions or maybe transparency issues. But again, I think as long as the market wants to attract foreign investors into the market, which is important from a liquidity point of view, we do see improvements on and on. Is it comparatively 10 years ago in China? I think depending. I think if for the larger companies, well-known companies, I think definitely they would be at par and of high standards. But of course, in the small medium cap space in India, I would say that, yeah, probably. I think maybe similar situation in China versus India. Yeah.
Okay, excellent. There's a question here about, I don't know the answer to this. I actually have never heard of this. Please say if you don't know the answer, that's fine. The Tesla Dojo chip, which I understand is the AI neuro engine chip. Who makes them? Do the Chinese make that Dojo chip? I don't know the answer.
I don't have it here, but I'm sure my analyst in especially the EV space, he would know. But we actually are on that. We do have a company that makes component 100% of the Tesla component, which is called, I said in the top 10. Let me see. It might not be in the top 10, but it's an Asia listed company. It makes a lot of air conditioning controlling components for like a lot of electronic appliances, including even Tesla. Actually, they supply to the China-made or US-made Tesla. So when you buy a Tesla, you need to control the aircon in the electronic panel. Actually, it's made by that company. Yeah.
Okay. And just to highlight what I've got up on the screen here, I mean, everyone is talking about nosebleed valuations with regards to, equity holdings. The Premium Asia Fund, even with its high allocation to consumer stocks and technology companies, we are trading at a P of 13 times. Okay, so when you compare that and you're looking for that diversifier, it's sort of another reason why, Asia is going forward is going to be a cornerstone investment allocation, and it has to be from a manager that is on the ground. The final question that I have here, Doris and Renee, is I think we may have touched on this already, but can we get your thoughts on, with all these continuous rounds of regulatory changes, and Doris, you may want to comment on what we talked about just before the start of this around what happened yesterday, where there was a sort of a discussion paper, a consultation paper around Macau gaming. With all these continuous barrage of regulatory changes and requirements, is this the tail end? I sort of note that Renee has alluded to, yes, we're sort of getting to the closer tail end of it, but your comments, ladies, on that?
Hello, Jonathan. About the recent regulatory changes, I would say if investors are not following China closely, starting from last year, they may make a comment that there had been surprise on the downside continuously until yesterday, the consultation paper announced by the Macau government. But if for investors, serious investors like us, who have been monitoring the sector movement closely enough, my response would be that it's actually quite predictable, even though we definitely have no insider information. But the direction for many regulatory policy have been very consistent, which is especially after COVID, the government has been putting huge emphasis on social welfare. So everything for sectors or policy related to promoting social welfare, which includes kids' welfare, income distribution, or activities that may promote certain kind of obsession behavior like that. Government are committed to build a more regulated environment, which are more regulated than 5 to 10 years ago. And one example that we just discussed about is Macau. Since Macau is obviously the gaming center targeted 90% targeted to Chinese gamers, and then the industry has two major segments. One is called the junket business, which is the high roller chip gaming business. That involves a lot of capital flow issues for many years already, and that has been under control since I would say 2015, because a lot of issue about money laundering, and then the credit issue also under government's concern. And then another segment of the gaming business in Macau would be the mass gaming. Comparing to Vegas, because I have been studying this sector for many years now. For mass gaming in Vegas, it means lottery machine, and really talking about per gamer spending rolling maybe 100 US per day per visit or so. But to China, to Macau is different. Because lottery is seen to be really an entertainment more than serious gaming. But to Macau, even the mass market gaming is never about lottery. But to standard that you may also surprise, for even just a standard gamer, their average spending per visit to Macau would be over 3,000 US. So on the table only, not talking about hotel, catering, etc. So it's from time to time, my understanding it's either the operator, they spend more effort to diversify their business to the real entertainment business, convention business, from this serious gaming business, because this is not very sustainable even from a commercial perspective. But the situation never changed significantly in the past 5 years. And then actually spending per gamers have actually gone up last 5 years because the crackdown in VIP. So after the tutoring crackdown, the tutoring policy came out, we decided that government has become more committed to regulating this gray area of business, and we think the time for Macau may be coming soon. So we decided to clean up our position, and then it happened yesterday.
Yeah, let me add also. Yeah, I think all the policies introduced are actually for the rationale for Chinese government is to first of all address the wealth poor income gap. They try to narrow it, and also like urbanization, and they try to continue to maintain social welfare, well-being. So all these are in these kind of directions. But and also like it doesn't help like when the Westerners they just read the newspaper and suddenly there's a policy change. Actually, all the like even education sectors, they have a lot of consultation paper launched 3 years ago. So we are very well aware of the rationale and thinking. But of course, it's not so apparent for external people. So that's why there is so much confusion. But I think it's okay, it's on track, and I think the policies are definitely the majority shocking or confusion timing has passed.
Yeah, and again, that's a strong reflection of being on the ground, right? And sort of having the on the ground presence, because we're not surprised by what's happening. Anyone who is surprised is a reflection that they don't have the resources. That's not a good, that's a bad thing, obviously, in our opinion, but that's not a wrong thing, because you simply can't be good at everywhere else. And, you know, ultimately, our view of the world is if you believe a global equity manager is going to, you know, be able to find the best stock choices for you for China, then the same rationale should be applicable to let your global equities manager choose your best stocks in Australia as well. But we don't. We choose Australian fund managers based in Australia because they have the on-the-ground presence. And this is in a market, frankly, in Australia that's far more transparent and has far more regulation compared to most countries across Asia. So China is already, you know, getting quite close to being well regulated from a capital market perspective. And I guess, you know, the domestic viewpoint here in Australia is, why would China implement any policy to reverse capital inflow and reverse the opening of their capital markets? They've spent the better part of 30 years opening up the economy to foreigners. They've opened up to foreign competition, and they've also opened it up to even foreign insurance companies and foreign banks to go in as well, because they want to diversify the capital base. All the policies now is all tuned towards common prosperity, which will normalize China's growth, but it'll also cause China to be, you know, fundamentally have less risks, less growth overall, but better quality growth. And you know what? The bottom line is that no matter which direction China takes, the US-China Cold War will continue for the next 30 years. And if you read enough Western press, you'll also keep seeing no matter which direction China takes, it's always going to be negative. That's not a bad thing. That creates information asymmetry for managers like ourselves, and allows us to find the best value, which we've been doing for 25 years and will continue to do so for the next 25 years. And frankly, our track record does speak volumes in saying that. So being conscious of time, as I said, ladies and gentlemen on the call, thank you very much for your time. When I end the webinar, you'll be asked to fill in 2-3 quick questions just on feedback on today's session. Once you fill in that, then we will obviously send through the points. There is 1 or 2 questions that we haven't managed to get round to, but we will come back to you on an individual basis. So thank you, Doris. Thank you, Renee, for your time. And I wish everyone a wonderful afternoon, and stay safe.
Thank you.
Thank you.
Bye.